Hi everyone, it's Jack back again with another video. Today I'm going to be analysing Walgreens Boots Alliance. Really famous company, a Dow Jones Industrial Average component with a long and rich history, primarily composed of the Walgreens stores in the US and Boots stores internationally, particularly in the UK. It's a $41 billion company with a 4% dividend yield, and it's a Dividend Aristocrat, having increased dividend for 46 years in a row. So nearly a dividend king actually, which would be 50 years in a row. Attractive company, obviously based on its income. Down in its luck recently now, $47 stock, 37% down since 2019. Obviously not fantastic gains, down significantly versus the S&P 500, so losing quite significantly against the market. But of course, when the stock is down, it presents potential opportunity, and I want to analyse that. Of course, when analysing any company known for its dividend, its ability to pay must be analysed first. At the most recent filing, the company has cash to debt ratio of about 0.11 with around $30 billion in cash on the balance sheet. This is not uncommon for a company of this age profile in the retail space, but is nevertheless not a particularly strong position. Debt to EBITDA ratio of 4.47 indicates the debt is not particularly well covered either. Company has been assigned an Altman score of 2.52, indicating the company is not at immediate risk of financial default and financial distress, but it is not a completely safe and financially secure business either. This balance sheet definitely needs some work, and management are exploring options to rectify the debt situation after a few large acquisitions. Margins are not particularly impressive relative to the wider business world, but for this industry they are pretty good. The operating margin of 2.83 is okay for the industry. Net margin of 4.76 is excellent for this industry and is very good for Walgreens Boots Alliance history. Return on equity percentage of 28.46, sorry, not 2.8. Very, very strong. Return on assets 7.15. Okay, on the more reasonable side, right in the middle of where I would expect, around 5 to 15%. Pretty good for Walgreens Boots Alliance's history. Return on equity is excellent for its history and very, very strong for the industry. Company also has a return on invested capital of 4%, which is again not so impressive but decent for a company of this maturity in this industry. Very hard to grow at a strong rate when your scale is so saturated as they are. This is a company that does $130 million in revenue roughly, so obviously serious scale here. Outside of a less than selling balance sheet, the dividend actually looks rock solid, whereas it's not what I would have expected. 4% forward yield, which is obviously quite high, well above the S&P 500 average, growing at 5.7% on average over the last 5 years. Payout ratio, just 27%, some of the best payout metrics you are likely to see for such a large yield. I'm pretty confident in this dividend going forward that it's going to be maintained and grew. A lot of valuation metrics here, a lot of dark greens. I'm only really interested in 4 of them in particular. PE ratio, the forward PE ratio, price free cash flow and price to operating cash flow. Trailing price to earnings to PE ratio, 6.37, positively dirt cheap in my opinion. Earnings seems to have been inflated by the vaccine sales, which we'll talk about in a minute, but even on a forward basis, 9.44 times earnings, very, very cheap, way below the S&P 500 average. And for a dividend aristocrat with 46 years of consecutive payments, this is very strange. Very, very low valuation. Basically pricing in a decline here. Price free cash flow of 10 times, also very cheap. Very strong versus the company's history and very strong for the industry. And a price to operating cash flow of 7.5. Very, very cheap. Very good for the industry. So there's clearly a theme here. Company looks very cheap. Very, very cheap for its industry. Very cheap for its historical valuations. And really, we're seeing a lot of negativity that's priced in here. And I'm not really seeing the reason why. Revenue has been up and down recently, earnings per share up and down recently, but this is not a company you would call that is in decline at all. Next up, of course, is the discounted cash flow analysis. First of all, I wanted to mention the revenue. Revenue 10-year average growth rate is 7.8%, 5-year average 7.2%, 1-year average 10.1%. So this is clearly not a company that is in absolute decline as the valuation would suggest, although EBITDA, earnings per share and free cash flow have all been a bit all over the place. So I choose to analyse by free cash flow. On a 10-year basis, this grows 6.8%, but on a 5-year basis, this is down 5.7% on average and 2.7% on average over the last year. Of course, this is partly due to a rough period in 2020 and 2021, numerous divestments and investments over the last 5 years, so I'm not going to ding it too much. I'm going to kind of go off that 6.8% free cash flow. But for the calculation, I'm actually going to use a 1% growth rate just to give an idea of how undervalued this company is. The 10-year average growth rate is 6.8. Instead of that, using a 1-year growth rate and a 9% discount rate for the long-term returns of the stock market, this gives essentially fair value, and that's why I'm doing it, is to indicate that fair value is pricing in right now just 1% free cash flow growth rate, or essentially no growth over the next 10 years, losing to inflation significantly. I believe this company can do 3 to 5% growth over the next 10 years or so, and that's, I think, being perhaps pessimistic. Of course, the company has a lot of problems. The balance sheet isn't great, but revenue is growing at a decent rate. 7.8% 10-year growth rate is pretty good for a company this scale maturity. If they could grow free cash flow in line with revenue, which they're kind of doing over the last 10 years, then this is very, very under-optimistic in my opinion, and will be positively dirt cheap by discounted cash flow valuation. Here are some analyst expectations for the next couple of years. Again, take these with a pinch of salt, of course, because they're estimations. An expected 130 billion in 2022 to 141.6 billion in 2024. Not blowing the doors off, but around 5% revenue growth at this scale for this price is absolutely fine by me. Earnings per share without NRI is predicted to grow at a decent rate going forward after a 1 year decline. Dividends expected to continue increasing. EBITDA expected to continue increasing. Everything here looks completely reasonable by my eyes. Analysts seem to be pricing in a decent bit of growth, whereas the market is not pricing this in whatsoever. Looking at some of these financials a bit deeper, for Walgreens in particular, sales up 3.2%. Again, this is a huge company with huge revenues. You can see just for the quarter, 28 billion in sales just in the US. This is a crazy number, so don't expect it to be blowing the doors off. What clearly is blowing the doors off is gross profit up 12.3% and operating income up 46%. Obviously, well above expectations, as you can see, driven primarily by strength in pharmacy and retail, aided by phasing out of SG&A spending. These are all positives. They're not going to keep them up for the long term. I think over time they're going to trend back to reasonable single-digit growth targets, as they've mentioned later on in the earnings report. But for now, they're executing well and they're making a lot of profit, which will be inevitably returned to shareholders or go to paying down that debt. Some of you may have noticed an uptick in the stock recently, and that was because the company was supposedly shopping the boots segment. Boots sales is estimated to generate around $7 billion, whereas previous valuations had it as much as $10 billion, so unlikely a sale will happen soon in my opinion. They had pretty strong numbers this year. Pharmacy comparable sales up 8.8% for the quarter, retail comp sales up 16.3%. Again, it's still still giving out vaccines, so this is to be expected. Basket size is now 12% above pre-COVID levels. These are all really positives. Of course, there are still some negatives. Store footfall was up 33%, but remains 20% below pre-COVID levels. So I hope there's some growth here and this can get back to its previous levels. And I expect it to do that over time, maybe not straight away. Boots.com, however, sales are 2 times pre-COVID levels, represent now nearly 15% of Boots' total retail sales, which is absolutely excellent. And they continue to grow their retail market share across all categories, particularly led by beauty, which is a higher margin category. In summary, I think this is a nice business with not great or at least imperfect financials. Great margins for the industry, and this holds it in good stead. As a less than stellar balance sheet, but despite this, the dividend looks very sustainable going forward with a nice yield at 4% and just a 27% payout ratio. So I can see future growth continuing for the medium to long term, as long as nothing strange happens with this business. Valuation is positively dirt cheap here, and the discounted cash flow indicates a fair value at just 1% free cash flow growth. So I think if it can do between 1 and 5%, which I think is completely reasonable over the next 10 years, it will be significantly below my estimated fair value and a positive buy. I want to see what happens after earnings at the end of March, and I want to see what happens the next 12 to 6 months with a possible Boots sale, because I like the Boots segment. I think it's a strong growth engine. But I like the valuation here for an income play, a 4% yield with below average but present growth prospects at a completely reasonable price. So for an income play, I consider this a buy. Personally, I want to see how it goes over the medium term, next 6 to 12 months, to see if they sell Boots, because I think that would be a bit of a negative for the company. Of course, none of this is financial advice and should be taken as such. You should do your own research and due diligence. Hope you're enjoying the videos. Please like and subscribe if you want to see the channel grow, and I'll see you again next time.